fellow investors. Welcome back to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, I've got a very special guest. His name is Morris Groberman, and Morris has been in commercial real estate for over 30 years. He's a principal with Northwest Commercial Real Estate Investments, and he's successfully completed more than 50 syndications since 1997 and raised over 150 million in equity to acquire properties. So I think we are really blessed to have you here today, Morris, to share your wisdom. It's not often that we get such a seasoned investor in-house to give us, to give us such a different point of view. So thanks for coming on the show.
Yeah, no problem. I look forward to this.
Yeah. So before we jump in, why don't you tell folks a little more about yourself and how you got started and then kind of how you got to where you are today?
Okay. Well, I graduated from college and went right into commercial real estate at Colliers as a broker. And as a broker, you learn from everyone and how to do business and what to do, what not to do, and you take the things you like and you throw away the things you don't like. But the one thing I did realize early on is that being a broker is great. You get some cash flow, but you don't build equity. And equity is where you want to be. So I had to figure out from being a broker how to get equity and how to start buying these buildings. Because later on in my career, all I was doing is I'd find the deal, I'd sell it to somebody, and I'd put the whole thing together. I'd get them their financing, I'd do all the due diligence, and all they would have to do is show up at closing with some money. And then it was over, and I got my check, but I didn't own the building. I should have owned the building. And I wish I owned all those buildings I sold. But it gave me that education and the confidence I needed to go out on my own and start buying. And so, what I did early on, and this is when I had hair, I went to, my investors, and investors, asked me, hey, Morris, you find a good deal, let me know and I'll buy it from you. So I wrote their names down on an Excel spreadsheet. We did have Excel then. And then I found a deal, and that was actually a deal I was selling as a broker. 3 people passed on it, and I went to the seller and I go, I don't know why these guys are tying this property up and then blowing out. So I said, hey, if I buy it for the price that they had it, would you sell it to me? So he said, sure. I want to buy this other building. So yeah. So I went and bought his building, and that's how it all started.
Nice. And what was that first investment? What type of building was that?
It was an 8-unit apartment building built in 1910. I still own it today. We bought it for $465, and it's probably worth $2 million today. Still own it. Just I refinanced it so many times. My investors have received their money back tax-free. And they basically, every time they do the refinance and get their money back, they just give it to me for my next deals, because that money they had allocated for real estate. So
Right.
I just keep giving them money back. And that's typically, how we've been able to keep growing. Is we don't necessarily sell. I've maybe sold 2 or 3 buildings in my whole career as an owner.
Really?
Oh yeah, it's so hard to find good assets to buy. And then you have to pay taxes and all this stuff. It's so much easier just to refinance, give your investors back their money, and then keep owning it. It's the devil you know versus the devil you don't know. And the buildings I have sold, except for the office building, I wish I did not sell. The office building, I'm still glad I sold.
Yeah. So let's start with just real estate. Why were you so attracted to real estate, and why did you choose that as your vehicle of choice?
Well, growing up, my grandfather and father were in the real estate business in Canada, and I saw what they did. And then my stepdad in Vancouver, Washington, owned a furniture store, and I saw what he did, and I said, I don't want to be in furniture. That's too much capital. And then you have to wait for people to come to you. I want to be a real estate broker because you can make some money being a real estate broker if you're good and you work hard, but you don't have any capital. You only have your time. And you don't have to wait for the customers to come to you. You can go to your customer and say, hey, buy this building. It's a great deal. So that's how I got into it. And I was with Colliers for 19 and a half years. And during that time, they had let me buy my buildings
Nice.
to
So you
start the
were,
business. And then finally, I just said enough is enough, and I
yeah,
can't do it all.
yeah, it didn't make sense anymore. You had too many assets at that point.
Yeah, yeah. And
Gotcha.
and candidly, I was competing with my customers.
Right.
They didn't
You
like
probably
that very
you
much.
probably found some pretty good deals though. You get the first
You know
look.
what? As a former broker, yeah, I knew all the owners in the market. I
Hmm.
became friends with them. They knew me, and so they would call me for advice or something, and we end up buying their buildings off market. I'm buying another deal off market. It's all about relationships in our business. Um, I would say probably 60% of the buildings we buy are off market, maybe 70. Um, it's just that people come to us first, and we're a known quantity, and they know we're able to close.
Hmm. Yeah, which is really the most important thing, right? That
Well,
assurity to close.
for owners and brokers, if they want to put it on the market, they want to know it's going to close.
Yeah, absolutely right. So tell us where you're investing.
Okay, I will tell you. So we invest in the Seattle area only. I learned early on in my career not to buy any property more than 45 minutes from my house, because you just never will see it. And the key is just being more on top of things. Don't get on an airplane. It's hard enough for me to drive 30 minutes to look at a building, let alone get on a plane to do it, etc. And if you know your market, there's plenty of buildings to buy and things to find in that market. But we own all asset classes now. Growing up, I started as a leasing agent, so I understood office leasing, industrial leasing, retail leasing. So we own office, we own industrial right now, and retail, and mostly multifamily. I owned an office building. I was an office leasing broker for many years. And my motto now is friends don't let friends buy office buildings, for several reasons. For one, tenant improvements, downtime, real estate commissions. It just eats all your profit alive.
Hmm.
And it's just kind of a pain in the neck. Apartments are so much easier to own and operate. Um, Retail, we own core asset in retail. Yeah, we are impacted a little bit by the COVID thing, but not as bad as others have been. Apartments, the same thing. We own about 1,800 units, and I have about probably 15 people not paying now.
Yeah, that's not
So
bad.
it's not. I'm not getting crushed by that. It's more of a pain. We did see our incomes, our rents drop in the heart of the problem, 15-20%. Plus, we have to give concessions. But we're back now to 2019 rents or above,
Yeah.
and we're just plodding along. I bought a couple of properties during this time. We're doing a lot of development deals now. Development takes a long time to do, so I'm going to break ground in 22 on about 3 buildings, and those will take between a year and a half and 2 years to build, depending on the size.
Yeah, and what type of apartments are you invested in? Like A, B, C? Is it urban, suburban, mix?
Well, we used to really just focus on the urban in city core Seattle, but
Hmm.
we've really spread out now. We're in all the areas of Seattle. We have a big tech presence here in the Seattle area, so we're trying to get those customers. We're just opening a new building in Kirkland, Washington, next to the big Google web campus. So that'll be pretty successful. We've already got all the commercial there rented. So I got 70 units to rent, but I can't rent them until they finish the building. Actually, we got a couple pre-rentals of just friends and family that wanted to get in there because it's such a great location. We're building on Queen Anne in Seattle, and we have 3 or 4 buildings now we're doing in downtown Bellevue that'll be mid-rises.
Gotcha.
We've been very busy during COVID.
It
It's
sounds
been
like
crazy.
you've taken
And I'm
advantage
buying
of it.
another building right now in North Seattle area. It just wasn't on the market, and it's going to put out for us a 3 to 4% cash on cash return. Plus, I have a lift in rents. So we said, "Oh, that looks like a good deal. Let's just do it." And the thing that's really helping us are the interest rates. They make
Right.
deals make sense.
Right. Yeah. And so I want to get your perspective here because you're unique to, I think, a lot of what I would say, a lot of what I hear, and maybe that's just the circles that I run in, but a lot of people or people that come out of training programs to be syndicators, things like that, are focused everybody's kind of pushed to the southeast, everybody's pushed to Texas, to maybe Arizona, right? You hear about Phoenix and Dallas and all the growth and things that are going on. Nobody talks about going to Seattle really, and investing in Seattle and making that work. But obviously you've been extremely successful. So I'm just curious on one, if you could enlighten us on kind of the market dynamics in Seattle, knowing, price per units are fairly high. You said a 3 or 4 cash on cash, that's a little lower than in some other markets, but so the dynamics are different. But also I'd love to hear that. I'd love to just hear your perspective on just making investments work there, and kind of the strategy on how you deploy that and make that work in Seattle, and why that's attractive.
Well, okay, so I could talk for days on this.
Yeah,
So sit down, everyone. We're gonna have a visit on Seattle and
we
real
got
estate.
time.
Yeah. So how do I start? So when I started in commercial real estate, Seattle was a very provincial area. No one really did necessarily, except the locals, want to invest in Seattle. And then we had, Boeing come, and they were a big presence here in the area, and then they left and went to Chicago. And that really
Mhm.
kind of upset the apple cart. But there was this weird company called Microsoft that was really starting to grow. And they're just huge here. And then, we have all these other tech companies and the biotechs. So as I always tell people, it's all about jobs, what we do, especially in multifamily housing. Everywhere I'm trying to locate my buildings is near jobs, and well-paying jobs.
Mhm.
And that's kind of what we look to do. And then if you look at all the institutional investment lists, Seattle is always at the very top of their list because we're really constrained by water. There's water all around us, so it really limits the land. And then we
Mhm.
have the zoning. So there's really high barriers to entry. And yes, our returns, just like the left coast and the right coast, um, those areas, those coasts have it's harder to get in there, and so the returns are a little lower to start with. But here's what's really happened to us in Seattle, I've been talking about this for years, when I was a broker and now as an owner, and to my investors. Um, it's really a capital appreciation play.
Mhm.
Things in Seattle, I don't know how it happens. Well, I kind of knew because rents double every 7 to 10 years. Values in buildings double, and that's a lot. And that's why our cash flow returns aren't as high as they are in the Midwest.
Mhm.
Midwest, you're not seeing that. You can get a 6, 7, 8, 9 cap. I mean, way better than our caps, and you can get better cash flow. But when you go to sell your property, you're not getting the appreciation like we can get on the left and the right coasts. Don't know what it is. It's really all about rents. It's all about job growth. It's all
Mhm.
about, you know, I, I go and peek in our applications. It's not my job, but I like to know who my customer is. So I'm always looking at the rental applications and seeing who they are. And these kids get $150,000 to start in computers. So with Amazon, with Facebook, with all these companies, they can pay these huge rents, and it's just pushing our market like crazy. So, this building we're building in Kirkland, I think my low rent for a little crappy studio is $2,300.
Wow. Yeah. That
2,300. I go, what? It blows me away. I've been doing this too long. I'm too old, but it's just really very fascinating. And these Google employees are going to be able to pay it no problem. And we're right across the street from their main campus, so
yeah.
we'll be fine. And it's just a wonderful location there. But yeah, our rents in the Seattle area for a new product vary between $3 and $5 a foot.
Wow, that is a different world than where I am here in Indianapolis for sure. But I love your perspective because I mean all the time I hear about the way most people talk about cap rates is that low cap rates are a bad thing. When I hear most people talk about, they talk about cap rate, oh, I would never buy a 4 cap. I would never buy a 3 cap, all this. But what I always try to tell people is like cap rates are not good or bad. They just are what they are. And you have to alter your strategy based on what the cap rates are and based on, like you said, if it's a capital appreciation market or if it's a cash flow market. And and I love how you've just developed the strategy around capital appreciation because that's the market you're in, and you're being very successful in a market where there's 3 caps and maybe even 2 caps.
No, no, I bought 2 caps. I don't mind buying 2 caps.
Yeah.
Because here's the deal: is you got to say, okay, I know the market pretty well, so I say, okay, if I do this to this building, will I get a 6 cap? Okay, and then there's a parking garage. I can build more units, or I can add units. So
Yeah.
that 2 cap I bought, which I did, I added 3 units into the building. So I went from a 30-unit building to a 33-unit building. And now we're mowing down the garage and we're putting up 27 units. The garage is free. It's free land.
Mm-hmm.
So that 2 cap I could have bought for a 1 cap and I would have still made money. You just have to look. People look so short term. It's like looking at the stock market. When I buy a building, I don't look at what's going to happen in 1 or 2 years. I look, okay, 10 years down the road, am I going to be happy I own it? And the answer to your question is basically, if you buy the right location, you'll always be happy you owned it.
Mm-hmm.
Location really does matter. You can never fix a location. You can always fix a building. And we fix buildings, and we run pretty good buildings. And I don't mind buying old buildings. I've bought a lot of old buildings. You can look at our website, nwcrei.com, and you can see all the properties we own and how we operate. It's fascinating, even to me, and I've been doing this all my life.
Yeah, no, I love the perspective. It's just different than what we hear most of the time. That was one of the reasons I wanted to have you on as well. And you and I actually, so folks know, Morris and I met through we were on a conference call together, and Morris actually gave me a great piece of advice on that call because I was talking about all the appreciation that I had seen in the markets that I'm in, and for Louisville, for example, is up kind of 30%. Building prices are up 30% over the last 8 or 9 months. And I was like, man, that's just really hard to take. And your comment right back at me was, you know what, you're looking at it the wrong way, in that you can't worry about what you paid last year. You're never going to pay this year what you paid last year, right? And you've got to look at the future. And if the future, like you said, looks bright and that makes sense, then that's okay. But if you're always thinking about what you paid last year, you're never going to buy another building. And so I really appreciated that advice, and it's exactly right.
Well, I bought my first few buildings at $50,000 a door, and I'm buying a building right now at $300,000 a door.
Yeah.
And it still makes sense. The rents are triple. So you just have to look at the future, and it's almost like buying a business, and candidly, I like to buy a business where the rents, for example, and most of the units in that building haven't gone up in 2 years because of COVID. They haven't been allowed to go up. In the next 6 months, they'll be able to go up. So I'm looking to be able to raise rents on current residents, whatever I need to get to market. And then it's interesting is that we're on the turns we're getting those much higher rents. And these are apartment buildings. People don't live there forever, especially the ones I own. And it's not because I'm kicking them out. It's just because they're apartment renters. They move. We're seeing 30 to 50% turn a year in the buildings, and that's just what it is. So we're able to get that turn and able to get that new rate. It's more difficult in commercial. You're signing 3, 5, 7-year leases. I don't like doing 10-year leases. I don't like doing options. We can go into that another day about lease negotiations for commercial
Hmm.
tenants.
Yeah, I mean that's one of the positives of multifamily, right? Is you have year-long lease and you can continue to stay up with market as those leases turn over in the shorter
And
time frame.
inflation. And
Yeah,
inflation.
and
Yeah.
inflation, right?
It's tougher on the commercial long-term leases. You try to have your CPI and your clauses, but you're typically able to only bounce them 3 to 5% a year. But if inflation's running higher, and I
Right.
remember the 80s when inflation was running higher, the early 80s, I was there for it. I watched my parents struggle in the furniture store holding inventory, and I just said, not for me.
Yeah. Yeah, that makes a ton of sense. So, what are we've talked about the dynamics of Seattle, how it's a different market, right? It's a capital appreciation market. We've talked a lot about the importance of rents and rents continuing to increase to turn that or doing things to turn that 2 cap into a 6 cap, right? Or be able to really push the value in these properties. But what are the key things that you look for when you're evaluating one of these buildings or one of these investments? I mean, what are the things that you're really honing in on that move the needle?
Well, I tell you, the main thing is we all talk about real estate 101 is location, location, location. It really does matter. As I said,
Mm-hmm.
you can never fix a location. You can always fix a building.
Mm-hmm.
I like to be able to add units in buildings. I like to be able to turn them around. We've done a lot of turnarounds in great locations. That's fine. The building I'm buying now is actually in decent shape. Just the rents are a little soft because he hasn't been able to raise the rents in 2 years, and interest rates are low enough. I'm able to get a decent cash on cash right out of the gates. For years I was buying buildings in Seattle here, offering my investments no return, zero cash flow, and just say, hey, we'll raise rents, we'll get the capital appreciation for you. Now we were able to do that, but they also like their cash flow now. And I'm getting older now, and so are my investors. So eventually we're going to have to sell, but they're not pushing me to sell. It's kind of interesting. They like the tax benefits. They like the cash flow out of the projects, and they know if we do sell, it's huge capital gains and
Mm-hmm.
depreciation recapture. So they'd rather if I just keep refinancing it. And I have some older investors, guys that are like 90 years old, giving me money. I go, why? Because I don't want to give the kids the money. I want to give them a building that's going to give them cash flow.
Right.
Okay, that makes sense.
Right.
I'll do
Yeah.
that. And then the kids get the stepped up basis.
Yep. Yeah.
So
No, that's I mean that's the best present you can get, right?
yeah,
Well,
I would think I would like that.
so tell me more about how your investments work, because it sounds like again a little bit different from kind of the normal crowd. It's a longer term hold play. So tell me about how they work as you seek to refinance. Are you returning equity back to the investors? Are they staying in the deal? And kind of how does it go as you go through the process?
Here, it's interesting. I started in saying, I started when I first couple buildings saying, oh, we're going to hold them from 10 years. And then we looked at each other and said, well, no, I think we want to hold them longer. And we're giving our investors back the money. They don't want to sell. They want to keep owning. So now I just say, I don't know what I'm selling. I'll just
Mm,
refinance. If you want to get bought out, I guess I'll buy you out, but at market. And no one does anything. They just like to stay in. I think the one thing that we're maybe different than others, and I learned this early on, is I report to my investors monthly. I give them a sheet about what's going on at the building, a little market report, and then they get their balance sheet, their rent roll, and their P&L statement. They know exactly what's going on. And so I think it's critical to keep your investors really knowledgeable about their asset,
Mm-hmm.
and they don't call me. They have the information, and they keep giving me more money because I'm not always asking them for money. I give them information, I tell them what's going on, and we're just part of their investment portfolio. And they like it, and I don't really have any complaints. All the investors know what they're getting into when they get into business with us. Now, as I said to you before, we started with 8 investors, and we're up to over 600. And I keep trying to grow that because, some investors come and go, and they don't want to, they've allocated enough into real estate, and so they're out. But I have some funny stories. I've, met with some tech guys, and they said, okay, I'm going to give you X dollars for these 5 deals that you're going to have, and then that's it. So that same guy is now, who said that to me, 5 deals, he's now in 15. I don't, he just, oh, I will do that one. I'll do, because they
Yeah.
come up with money and they don't want to put it in the stock market. They want
Yeah.
to diversify. And the one thing they can do in Seattle, because I don't reach out to anyone else, is they can go drive by their buildings. And and I always offer my investors, hey, you want to walk through? I want to see your building. No one takes me up on the offer. And well, I have a friend of mine that gave me a lot of money. He's actually a tenant in common investor with me. And the one thing he was so proud of, and he still is to this day, and he invested, we bought this building together in 2005. He says, Morris, I've never seen the building. And he lives in Bellevue, which is across the lake from Seattle. And this is right off of Broadway. I don't want to see it. I'm so proud I haven't seen it. Because he trusts me, and that's
Right.
our business. It's about trust and transparency.
Yeah, no, I love your message about communication. I don't think enough people do that. I mean, it's something I actually try to do as well, is send out monthly updates to the investors, because when I started as an investor, passively investing first, that was one of the things I hated, was like, you give somebody money and you wouldn't hear from them for 6 months. And you're like, what the hell's going on with my property? Like, are we good? Are we bad? Like, where are we? So I completely agree with that. And I'm sure that's a huge part of your long-term success.
Well, and we do quarterly updates about the market, especially during COVID. We did Zoom calls with all of our investors because everyone was concerned, and candidly, so were we.
Yeah.
When they're talking about rent strikes, how is that going to impact us? I mean, that could be really a problem.
Mm-hmm.
So we really kept abreast, and we keep everyone abreast. We work with all the local people around, and I know most of the local syndicators of what I do, and property managers and appraisers. So we're really kind of on top of this market, and that's the only way to be. I really know the Seattle area market very, very, very well. If I went
Mm-hmm.
into Portland or Phoenix or some other market, I wouldn't know it as well. And candidly, if a building came on the market, the local Phoenix guy would get it before I would, and I wouldn't know if it was a good or bad deal. The guy would just swoop it up, just
Mm-hmm.
like I swoop up these deals that aren't on the market here. People bring it to me, and we just go and buy it, and the outside people don't ever see it.
Yeah, I mean, I think there's a ton of value there in owning your backyard and knowing the market, and being the first to the table because you have those relationships. I think that's why it's so difficult to enter other markets. It seems like you always end up paying a premium for that first one, because that's the only way you get in. Is you gotta come in above and beyond what any of the relationships,
Or
enough
what
that
the
that
local
they don't care
players
about the
think it's worth.
relationships. Yeah,
Yeah,
exactly. Which kind of tells you something, right? If all the local guys don't think it's worth that, then is it?
it's not. Well, again, the thing that's saves a lot of people in real estate, especially if you don't tell your investors you're selling in 2 years, is time.
Right.
Time heals all wounds. And I'm telling you, the second building I bought back in '99, January of '99, I thought I really screwed it up.
Oh yeah, I
And
bet.
yeah, and it was just tough on, and it was a really, I really had to work at that. And that's turned into be a tremendous winner for us. And it's just time took care of it, and all the development around it.
Hmm.
And I still own it today. So again, that's the second building, and that was 99, and we still own it. We just won't sell.
Yeah, I love that. I love that. So you've obviously had a very successful career over a long period of time, and so how have you been able to maintain your success like through all the ups and downs, through the different cycles? I mean, what's your philosophy on how you continue to just be as successful as you are?
Heads and beds. That's how we do it through the cycles. Even in COVID, I'll drop my rents faster than anyone else just to keep cash flow going.
Uh-huh.
And so we were able to keep cash flow going. Um, I think I don't think we cut distributions during COVID for any of the buildings outstanding. So that was kind of interesting.
How often are you distributing?
My commercial building we had to because two of the commercial tenants weren't paying rent, but
Hmm.
I have 15 others, so we just cut it a little bit. But the apartments have been just fine. Yeah, and the other thing that we've done that's pretty smart, I thought, was we have these significant reserves in the
Hmm.
apartment. When we do a refi or even when I buy buildings, I have capital reserves.
Yeah.
It's
Tell me
called being
more.
able it's called being able to sleep at night.
Right.
And my investors, they say, why do you have so much cash? And COVID showed us why we have so much cash.
Yeah, 100%. So tell me more. What kind of reserves are you putting in? Are you allocating to specific things? Is it just kind of a bucket of cash? How do you?
It's just a bucket of cash, 300,000 bucks,
Hmm.
and it just stays in the building. And if I have a negative month, it doesn't impact us. We just keep going because
Yeah.
you have higher turnover months are more costly, and so it just balances everything out. The one thing that was the first thing I learned actually on my first building is I
Hmm.
didn't raise enough money, and so the reserves were coming out of my back pocket. And when you feel that yourself, you learn. And so the
Yeah.
next deal, I said, "Oh, maybe we should have some reserves on this." So I got about 50 to 100,000 in reserves on that, and that was fine. So depending on the size of the building, let's say we'll do 50 to 300,000 in reserves.
Gotcha. I love that. And I think that's really important for everybody to understand that's listening to this because that it's so critical. And I think that's where people start to, you start to want to make a deal work, right? It's not quite at the number you want, and you start to cut things in your spreadsheet. And I think those reserves are some of the first things to be cut. But at the end of the day, it's critical to invest with folks that are putting reserves in place because if they're not there and things go wrong, I mean, the net, unless it's coming out of your pocket like it was Morris's, I mean, the option is you go back to the investors and do a capital call and say, hey, you know what? It's not working. We got to throw more money at it, and hopefully you're not throwing good money after bad. But those reserves are critical to making a deal work. When people talk, everybody always says they have conservative underwriting, right? Like nobody has ever been like my underwriting's aggressive. But the way that I really consider conservative underwriting is exactly like you said, Morris, is you've got to have a decent amount of cash sitting there for that rainy day that you don't know may come.
Well, I mean, we have bad roofs, we've had bad boilers, we've had just a number of things happen.
Hmm.
And yeah, I've never done a capital call, nor will I, because we have the reserves, and that really does help us.
Yeah. Yeah. I mean, I think especially in the market dynamics you're in, there's a ton of appreciation, which is great, but margins are thinner from a cash flow standpoint. So it's even
Yep.
more critical to have that cash on the side to sustain if, like you said, you got to drop your rents, you got to, to keep those heads in the beds, like you said. I imagine that's extremely important there with the dynamics in your market as well.
Yeah, I mean, our rents went down 15-20% plus concessions. It was brutal.
Hmm.
But we just sucked it up, took it. And these people that got their great deal for a year for it's going up to market again, and we'll be back to normal in 2022.
Yeah. Like you said, time heals all wounds, right? So as you're looking out right now, you're looking at the market, you're looking at what's coming up over the next few years. I mean, what advice do you have for folks as they're looking as they're evaluating investments, as they're looking to make an investment, with someone like you or me or anyone, what advice do you have for folks? What should they be paying attention to?
It's pretty simple. There's a poem that I read that I have somewhere. I can't. It's called Buyer's Lament. Maybe we look it up online.
Yeah.
It's an old poem from the 70s, and about a guy that always thought he should be buying these buildings, and all of a sudden he didn't. And then he saw them go up in value, and then he couldn't buy them because they went up too much in value. Here's the deal. If you want to own real estate and you don't want to do the work and you don't want to have your wife show it on a November evening when it's dark and blustery and meeting some stranger, you give it to the professionals and get and diversify your portfolio into some real estate. I said to people, I don't want all your money. I just want a sum of it, and just diversify. That's all you need to do. And they listen, and it seems to be working, but you just need to do it and not worry about, oh, I could have paid $200,000 a unit last year. It doesn't matter. It's what you can pay now. And the future is only, going to be brighter, I think, in terms of rents are only going to go up, especially in the Seattle area. We got tremendous job growth. We have tremendous population growth. And we have constricted area to build and zoning laws. So I think Seattle's just going to be great, especially the east side of Seattle, where you have all the tech companies, Microsoft, Google, Amazon is moving more to Bellevue. But the interesting thing is that a lot of the Amazon employees are younger in their 20s, and they all want to live in Seattle. And Amazon has these buses that commute people, and so does Microsoft, back and forth from Seattle to their offices in Bellevue and Redmond. It's fascinating.
Yeah, no, I mean, I couldn't agree more. I think we're in a unique time right now. I think whether you're looking at Seattle or you're looking at most markets in the country, there's just not enough housing. There's not enough rentals. So as you break it down simply and think about supply and demand in an area where, demand is outpacing supply, what happens? Well, prices are going to go up, right? That's kind of econ 101. And I don't think we're going to be out of that situation for quite a while, just based on how we've projected building and the new supply that's coming online. So I agree with you. I think it's a unique time from a demand standpoint. I think it's a unique time from just how, like you said, interest rates are so low and how cheap money is. And then all the stimulus that's been pumped in and all just the extra money that's floating around that wasn't 18 months ago, right? Trillions, $12 trillion.
Well, what about this new the transportation package for like 1.2 billion? It's just
The infrastructure
bill,
yeah.
Infrastructure. It's just going to spur more inflation. And what's a great hedge against inflation? I don't know about Bitcoin, but gold has always been there, and certainly real estate. But the one thing about real estate is it's a tangible asset, and you can see it, you can feel it, and it provides cash flow, and it provides tax advantages, and that no other asset does. Stocks don't do that unless you do your margin calls. But real estate is really a great vehicle to invest in if you do it right and you go with the right people that know what they're doing, and they're conservative enough yet know the market to be able to grow the values.
Yeah, I'm interested in how, I'm sure you get this question. So a question that I get, or just as I talk to new investors, kind of a common frame of mind, I would say is, oh, real estate's risky, right? Real estate is risky. That just seems like a general thing that people think for some reason. I'm sure when you get that question, how do you answer that question?
Well, here's the deal. I've invested in some stocks, and they went down from like, say, 20 to 0, and I lost all my money.
Yeah.
Real estate, at least you have something. You have an asset, and it's always going to be worth something. Now, unless you over leverage it. But typically I'm doing this new deal, and my loan is going to be 60% of value. So it's not like I'm it's really over leveraging these things, and people know
Yep.
we don't do that. And again, if you're concerned about that, you shouldn't invest in anything. You should just keep your money in the bank, and then it'll actually do negative because the amount of money you're making from the bank and paying the taxes on that, and then with the inflation, your money's not growing at all. So, put it in a conservative, asset. And real estate's more conservative as far as I'm concerned than stocks. And it certainly doesn't go up and down on a daily basis like stocks do, up, down, depending what the market feels like.
Mm-hmm.
We just got to feel good about that location and invest in the location, but mostly invest in the sponsor. You believe in the sponsor. And that's how we've been able to grow our business so well, is that, everyone has cocktail talk and they say, hey, this is what I've done. And then all of a sudden from the cocktail party, I get a couple of phone calls. Hey, what do you got? I go, I got nothing, but I'll put you on my list.
Mm-hmm. Mm-hmm.
It's not like I'm at a point in my career now that I don't have to buy another deal to be successful. Everything's just great, but we do it because we're having fun doing it and we enjoy doing it. And I don't want to be at home, sitting at home, just doing nothing. I want to be active. I want to run the company. I want to be just really involved in the community.
Yeah, I love that. I love that perspective. I mean, and in 30 years, I want to be exactly in your shoes. So I love hearing you're still having
Without
fun
my
doing
hair, you think you're gonna keep it?
Well, I said in your shoes, not necessarily with your hairstyle. But Morris, it's been awesome having you on. Before I let you go, I want to take you through our keys to success round. There's 4 questions I want to ask you that I ask all the guests. And the first one is, put yourself in your investor's shoes. If there was only one question that an investor could ask you, what is that? What should that question be?
um, are you going to deliver what you say you're going to deliver? Yes. There's so many things that go into what we do, so that's just interesting. But
Yeah.
again, I think the one thing that we've been able to do, that why we've been able to maintain all our investors and get new ones, is just the reporting on a monthly basis
Yeah.
and the quarterly basis in the market reports. I really think that has really helped a lot. And again, we try to be as transparent as possible with our investors. That's so important. I'd love to take more through the buildings and show them what they own, but they don't want to go. They just want a passive investment and know that we're going to deliver, and that their monthly checks are going to show up in their bank account,
Yeah.
and they're going to get their K1s in a timely manner. So we auto deposit all their money, and we provide the K1s in a timely manner on our investor portal.
Mm-hmm. You do what you say you're going to do. That's really the underlying truth
Yeah,
of it all. I mean,
sure.
the reporting is a cherry on top. That's fantastic. But you do what you say you're going to do, and you've hit the returns that you promised, right? And that's why they stay with you.
Sometimes it takes a little longer to hit the returns that you promised. We'll be honest about that. Sometimes
Yeah.
it does, but then all of a sudden you're way above the returns that you promised. So, that's what's great about real estate.
Mm-hmm. So, what are you most proud of in your career?
I think how we built the business successfully, and how we treat our employees and our residents and our buildings. Um, and I think that's the happiest thing for me. That was the scariest part for me, is actually, it's just like when you're a father, you have kids. Oh, you got more responsibility, right? But when you start having employees, they're like kids, and it's a lot more responsibility. If you screw up, you got a lot of lives on the line too, without that are on unemployment. So we're
Mm-hmm.
very cognizant of that, and maybe we become more conservative than I was when I was younger, because we just don't want to mess it up for them.
Yeah, no, that's awesome. You've built a community and you're taking care of them.
Yeah.
What's a book that everyone should read?
Well, The one book that I tell all the real estate brokers to read, and I still laugh about it, but this has nothing to do with investing, but it's about brokerage, and that's where I learned. It's called Winning Through Intimidation. And as you can tell, I'm not an intimidating guy, and the book really isn't about intimidation, but I thought it was just such a great book when I was a real estate broker, and I just loved that book. That was just so good, and because it really has nothing to do with the title, and it's a short book that I can actually pay attention to.
Gotcha. And then last question for you. What is your number one key to success?
You know what? I'm here at the office. I work hard. I answer my calls. I respond to my emails quickly, and people can trust me. Simple.
That's great.
Mostly
And
the trust part.
the trust part, and
Well,
you show
do
up.
what you say you're gonna do, and if you're not, tell them why, and be transparent.
It's as simple as that.
Really, people don't do it though. I've
Yeah.
seen so many syndicators fail. It's just, and then they wonder why they don't get money. Is because they don't report. And people are saying, well, what happened to my money? Oh,
Mhm.
well, you'll get your K1. Oh, whatever.
Yeah, and that's the difference between somebody that's had a 30-year career and been successful, right?
Yeah, really.
The
I mean, it
proof's in the
really is. I
pudding.
see them come and they go, and we're just consistent.
Hmm. Yeah, I love that message. Well, Morris, it has been fantastic having you on the show. If folks want to learn more about your company and what you're doing, how can they get a hold of you?
Just go to nwcrei.com. That's Northwest Commercial Real Estate Investments.com. See a bunch of our projects. And then there's a place if you want to contact us, you can contact us. And I'll talk more about, our philosophy on real estate investing, because it really is a philosophy. It's an art, not a science.
Hmm.
And you just got to trust your gut. And, I've been doing this so long, since I was 21 years old in brokerage and then ownership. This is all I know. I couldn't do anything else.
And you love doing it, so you don't have to.
I love doing it. It's right.
That's awesome. Well, thanks again so much for coming on the show, and
Yep,
hope you
no
have a great
problem.
rest of the day.
Thank you. Take care.